Investors are wondering what are they going to do with their portfolios amid these swings in the market. Let's bring in Jack Janasiewicz, portfolio manager and lead portfolio strategist at Natixis Investment Managers Solutions. Thanks very much for coming on the show.
No, thanks for having me.
Insofar as these things can be explained, what do you think has caused the rebound in stocks today?
Well, I think we're certainly now shifting maybe away from trading on emotions and moving back to looking at the fundamental backdrop. It certainly feels like we had some technical related selling, but even more importantly, I think maybe some of these economic numbers that have come out more soft have been interpreted as a harbinger of a recession. And we might be getting a little bit ahead of ourselves with that extrapolation. So back to fundamentals and getting rid of some of the emotional side of this.
Sorry, in what way was the market getting ahead of itself potentially?
I think when you start to look at some of the softening in the economic data more recently, we've already started to see some people starting to extrapolate that directly into a recession. And I think that might be a little bit of an overshoot right now.
Right. We're not necessarily. The Fed might pull off the perennial soft landing. What about tech? Are people disenchanted now with tech? I mean, as of this morning, the NASDAQ was off more than 10% from its record high.
Sure, and I think part of that has to do with some of the expectations. When we look at what's been announced so far, especially from some of those mega cap tech names, the Magnificent Seven, right? The earnings have actually been decent. It's just that expectations were even higher. And so falling a little bit short to us doesn't necessarily mean bad things are happening. It's just expectations got a little bit ahead of itself. And when you start to talk about some of the de-risking that's been going on over the last couple of days, those crowded trades include a lot of those big cap tech names. And so it's not surprising you get a combination of decent earnings, but maybe not meeting expectations and crowded positioning. And those are the ones that are going to see some selling in here.
Would you be tempted to go into some of these AI darlings, such as NVIDIA right now?
We'll get a little bit more, I think, insight into that, especially at the end of the month when NVIDIA reports. But all systems are still pointing to the fact that there is some legs still in this trade. And it's really the CapEx cycle. Are companies spending money on this front? And so far, we're certainly seeing signs of that continuing.
I suppose the risk is if they decide, or their eagle-eyed chief financial officer say, what's our actual return on invested capital here?
And that's the trick, right? You've got the capital takers and the capital providers there. And I think the ones that are investing right now are going to be a little bit on the hook for that sort of commentary. What are we getting for these investments? But the people that are selling, the company that are selling those products, one man's revenue is another man's earnings. And that's going to continue to drive that bottom line for them.
The Fed, have they left it too long to cut interest rates, do you think?
This is a tricky answer simply because there's certainly plenty of room for them to have gone at this last July meeting. When you look at where inflation is, to us, it certainly appears that the risk is not for higher inflation. It's for inflation to continue to trend lower. And again, the Fed dual mandate, they also have the labor side of the equation. And the risk on the labor side is probably for that unemployment rate to drift higher. So from that perspective, I think there was plenty of cover for them to go in that July meeting. But, if you listen to the commentary from Powell during the presser after that, certainly left the door wide open for that September cut. So, it certainly looks like September will be the go position for the Fed to begin that easing cycle. Just the problem is between now and then, 6 weeks, there's a lot for the investors to digest on that economic front.
I wonder, is Jay Powell breathing a sigh of relief today, seeing the market up? Because, of course, he must have been a little worried. Gosh, did I leave it too long?
Yeah, and the risk for us on this front is simply that some of this ultimately bleeds into the broader economy, right? Certainly, the stock market does its own thing. Some of it's sentiment driven, but when you start to get the potential for that damage to investor confidence, that's when you can start to see it bleed into the real economy. So that's something I think we need to keep an eye on here if we continue to have this persistent volatility and softness in the equity markets.
We do have, obviously, that tragic backdrop in the Mideast. Iran, the latest I saw, was threatening a measured response to the killing of that Hamas leader in Tehran. But there are fears of an escalation.
Certainly, when we start to talk about that wall of worry, geopolitical risks coming out of the Middle East, that's going to be one of those bricks within that wall. And, from a portfolio management perspective, it's really tough to really try to plan for something like that from a portfolio perspective. So, the market's probably going to end up being more reactionary than proactive to that. And that's certainly a risk that we're keeping front and center.
We've only about 30 seconds left, Jack, and you touched on this earlier, but would you be tempted to boost your allocation significantly in tech right now, or are you the mega cap tech, or are you holding off?
No, I think there's a case to be made where there might be some bottom fishing going on here. Is the selling from a technical perspective done? Might there still be a little bit of offside positioning that needs to get cleared out? Sure. But I think when you start to look out again farther over the next couple of quarters, these companies are still putting up 20, 30% growth on the bottom line. Margins still twice what the average, U.S. equity player is. There's still a lot of good things with these tech companies that I think make it worth considering for bottom fishing in here.